All right. Today we are going to discuss the central banking. Okay. Today we are going to discuss the central banking. Now, we have been discussing some issues related to banks ever since we started the program, right? We have been discussing some issues related to banks, but also we discussed some issues related to, let me put it this way, we discussed some issues related to financial institutions, okay? Financial institutions, right? And uh, somebody's microphone is on. Could you please mute your microphone? Okay, and we saw that financial institutions, okay, financial institutions can be depository or non-depository financial institutions, okay? But at the end of the day, they are financial institutions. One day, I highlighted something about regulations and supervisions, okay? Regulation and supervision. And that is to say now, financial institutions are highly regulated by what? By the regulatory authority, right? They are highly regulated by the regulatory authority, all right? And in most cases, in many countries, okay, the central bank is the one that is responsible to license and oversee or supervise these financial institutions, all right? But also a central bank is a very important instrument of any government, okay? It's a very important instrument of the government of any government, where it is used to execute, okay, to execute some policies, okay, some economic policies which are very important or which are vital for a stable economic growth, okay, for a stable economic growth of any country, all right? Therefore, as I mentioned, today we're going to discuss the central bank. So we're going to see some policies, the meaning of the central bank, how it operates, and depending with the time, we might even discuss some central banks, some notable central banks in the globe, okay? All right. So, what is a central bank? Okay. What is a central bank? A central bank simply means a financial institution responsible for overseeing the monetary system for a nation or a group of nations, okay, with the goal of fostering high economic growth without inflation, okay? There are some keywords here. There are some keywords here that we need to pay attention to before even we move further, okay? What is a central bank? We are being informed that a central bank is a financial institution. So that's the reason when we discuss financial institutions, we say central bank is part and parcel of financial institutions, okay? And the other day when I drew the financial system, okay, I resemble the central bank as the sun, just like the sun in the solar system, right? So the central bank is a financial institution that is responsible, okay, is responsible for overseeing. To oversee what? To oversee the monetary system of a nation or group of nations. When you say to oversee monetary system of a nation, for example, the central bank that is responsible to oversee monetary system of Tanzania is the Bank of Tanzania, abbreviated as BOT. US, that is the Federal Reserve, okay? So it is responsible to oversee the monetary system of a nation or group of nations. When we say group of nations here, we mean that there are some nations that for some reasons have come together to form some sort of a union, and they want a certain organ to be responsible to oversee the normal functioning of the entire economy in unison. So here I can give you an example of the European Central Bank, abbreviated as ECB. Okay, European Central Bank. But also, the United States. Okay, United States, that is a union of almost 52 states, if I'm not mistaken. All right. Therefore, Federal Reserve oversee the monetary system of all these states. Okay. However, in the United States, almost every single state has its own central bank. Okay, every single state has its own central bank. You should know that. Okay, it's not that all the states, okay, all the states have only one central bank. There are central bank in each state, but also there is a Federal Reserve, and that's the reason the way they elect their governor is a bit different, and the way Federal Reserve operates is somewhat different from what the Central Bank of Tanzania is operating. All right. So all in all, the central bank is doing this in order to achieve what? Economic growth without inflation. So you see here, we see that we might have economic growth, but also there's a question of inflation. All right. So the central bank is supposed to ensure that the more the economy grows, inflation is as well taken care of. Okay, that's the meaning. Now, in our case, the central bank is known as the Bank of Tanzania, established back in 1964. The central bank has a number of functions as described here. Number one, the central bank is responsible to control and issue legal tender. Okay, that is to say, the Central Bank of Tanzania is responsible to print notes and coins. Okay, but not only printing, it prints and also supply. Right? So the Central Bank of Tanzania is responsible to supply notes and coins. All right. And how does the central bank do this? By using mostly commercial banks. Okay, mostly commercial banks. Therefore, commercial banks, these are the agents of the central bank in executing some of the functions of the central bank. Okay, central bank uses commercial banks even to execute some of its policies. All right. And then again, the central bank is responsible to license, okay, and to supervise all financial institutions within a given economy. Okay. Today, if you want to open a certain financial institution in Tanzania, or if you want to open, for example, a bank, okay, you have to seek a license from the central bank. So you will apply, the central bank will go through your application, and if you pass it, then they're going to give you the license. But after giving you the license, they do not let you operate. You will be reporting to them, to the central bank. Why? Because it has to supervise activities, okay, all financial activities within the economy. Central bank is as well responsible to control credit expansion, liquidity, money supply in the economy. All right. Look at the three issues here: credit expansion, liquidity, money supply. Okay. What is liquidity? Liquidity, in finance perspective, I can say the easiest an asset can be converted into cash. But here, what we mean actually is availability of cash within the economy. Therefore, it is responsible of the central bank to oversee availability of liquidity of cash in the economy. You remember some few years ago back in Tanzania, we have a say, very famous say, vyuma vimekaza. Okay, so actually we are addressing the politicians, the current regime by then, right? But actually, who is responsible to oversee these issues and who is supposed to take care just in case it's true that there is a liquidity crisis within the economy? It is the central bank. And the central bank tried to do some measures, okay? One of the measures that can be done by the central bank is through credit expansion, okay? Credit expansion, that is the central bank control amounts of funds, okay, that is raised into economy through loans. All right, that's credit expansion, okay? But also there's an issue of money supply. How much fund do you want to have in your economy? Again, this one is the responsibility of central bank. So there are some issues. If you've gone through economy, there are some issues like M1, M2, V1, V2, this velocity of money, M1, M2, okay? It's the responsibility of the central bank to do this, all right? Why the central bank has been entrusted with this function? Go back to the definition. Central bank is responsible to oversee high economic growth without inflation. If central bank fails to control money supply, to control expansion, and even liquidity, the economy may end up either with recession that can be contributed by either inflation or deflation, okay? Inflation or deflation, both can lead to recession. Again, the central bank serves as the lender of last resort, okay? The central bank serves as the lender of last resort. What does this mean? Okay, what does this mean? If a bank is in crisis, okay? If a bank is in crisis, whenever a bank is in crisis, for example, a serious liquidity issue where the bank fails to honor customers' request, like withdrawal of funds, the bank has suffered some massive losses, okay? Has suffered some massive losses due to high rate of default or high rate of NPL. For the bank to run, it can go to the central bank to ask what? To ask for a rescue, okay? It can go to the central bank to ask to be rescued. Why? Because whenever other banks deem that a certain bank is in serious problem, they won't lend him money. It will be difficult for that bank to get money to continue with the operations, okay? There are some famous banks which I'll love you guys to spend your time to study about them. The Royal Bank of Scotland, RBS, okay? But also the Lehman Brothers. RBS was a commercial bank, and Lehman Brothers, this was an investment bank. When Lehman Brothers got into trouble, it ran to the Federal Reserve to ask for rescue. Federal Reserve refused, and once Federal Reserve refused, Lehman Brothers collapsed September 2008. And there is where a serious financial problem or catastrophe was triggered all around the world. We call it the global financial crisis, okay? Royal Bank of Scotland, when it was in a serious liquidity problem, it ran to the Bank of England, okay? It went to the Bank of England. Bank of England granted the request, okay? Therefore, whenever a bank has some problems, okay, it can go to the central bank and ask you to be rescued. Conversely, in Tanzania, we have some very good examples, okay? Meridian Biao, okay? Actually, this one collapsed. It was in Tanzania. Then we have Twiga Bank, all right? We have Twiga Bank. Twiga Bank was bailed out 2 times by the Central Bank of Tanzania, but since it couldn't continue to perform, then Twiga Bank was transferred to another bank, which is Tanzania Postal Bank by then. Now it's TCB, all right? But it was bailed 2 times, all right? And maybe it was too lucky because it was a government bank. I'm sure if it had been like Meridian Biao, which was a private, private bank from Uganda, most likely it would have collapsed for good. Okay. However, also there are some stories that Meridian Biao, there was some political issues. Now, I don't want to get into politics. Again, central bank is a government banker. Okay. The government banker, meaning that it is at the central bank where the government keeps its assets, okay? The government keeps its assets. Therefore, gold, some other precious metals, notes, and government funds, etc. They are kept at the central bank. Not only this, but in case there are some deals, okay, which the government is supposed to sign, let's say some contracts, all right, central bank usually serve as the government, at the agent of the government, okay, because at the central bank we believe that officials who are working there has sufficient expertise required to advise the government whenever it wants to enter into some sort of contracts. Now, for the central bank to perform well, it has its policies, okay? It has some policies. Now, we call these macroeconomic policies. Now, these policies are of paramount importance. What are these? Actually, every single policy has its own objective. Okay, the central bank, if the central bank wants to achieve something, it has a certain policy that can be applied for the central bank to successfully achieve its goal or objective. Now, the first policy is known as the monetary policy. Okay. The second policy is known as the fiscal policy. Third, exchange rate policy. Fourth, prices and income policy. And last one, the national debt management policy. Okay, these are the 5 policies, okay, that the central bank usually use in order to achieve its goals or objective. All right. Therefore, we're going to discuss this policy one to the next. All right. Now, even though the central bank has a number of functions, okay, and it uses different policies to achieve whatever those objectives, but it has this very, very important function, and that is to ensure a very good control of monetary operations. Why? Because a very severe crisis can originate from monetary issues. Okay, factors such as inflation and interest rate can trigger a very big problem to the country if not monitored closely. Right? That is the reason now the central bank applies monetary policy. Okay, the central bank applies monetary policy in order to influence interest rates, inflation, and credit availability. Right? The monetary policy is being used by the central bank to influence interest rate, inflation, and credit availability within the economy. How? Through changes in money supply. Okay, through changes in money supply. This is one of the very important policy that assists the central bank to achieve its functions. Now, for the monetary policy to be achieved, there are some tools that can be used, right? But also, sometimes it may warrant the central bank to use a combination of policy. Okay, just like in medicine, all right? Just like in medicine, sometimes doctors can prescribe to you a single dose of a specific medicine, all right? But if problem persists, or if the problem is too big, doctors can prescribe more than one dose of different medicines, hoping that collectively they will go to have a tremendous effect on whatever is affecting you in order for you to have a fast recovery. So same is applied by the central bank. If we have a serious economic problem, the central bank can opt to use monetary policy and another policy such as fiscal policy in order to achieve the desired objectives. All right, gentlemen, ladies, I want to tell you one thing. It is very possible, okay? It is very possible for a central bank to use two or more policies, okay? Two or more policies at a time. But it is impossible. It is impossible for a central bank to use two or more tools of the same policy at the time. Okay? It is very possible for the central bank to use two or more policies at a go, but not two or more tools of the same policy. I think even in the medicine it is the same, okay? If you're prescribed to use, let's say, penicillin, okay, an antibiotic, then it is possible for a doctor to prescribe another antibiotic, for instance, metronidazole, in support of this antibiotic in order to treat you with any problem that you are facing. But it is impossible for a doctor to give you penicillin, 2 doses, for you to take it at par. That will be an overdose. So you might end up collapsing. Now, let's see the objectives of the monetary policy. What does the monetary policy want to achieve? Okay. Monetary policy wants to achieve high employment, price stability, stable economic growth, rate stability, financial market stability, and stability in the foreign exchange market. This is what the monetary policy wants to achieve. Look, if you do have high employment, meaning that unemployment rate is declining, most likely your economy will boom. Individuals will be happy. But the high rate of employment does not come for free. It has a cost. Why? High rate of employment might lead to instability in prices. If you're not careful enough, you might experience price rise. And a price rise can trigger what? Can trigger inflation. Professor Phillips of Australia described the relationship between inflation and unemployment by using what he calls the Phillips curve. Okay? By using the Phillips curve, Professor Phillips said that it is impossible for a country to achieve a low rate of inflation and a low rate of unemployment at the same time. Why? Because inflation and unemployment trades off. Now, if they trade off, it means if you want to achieve low rate of unemployment. Now, remember, the low rate of unemployment, this is unemployment, this is zero. Low rate of unemployment is right here. So if you're going to have low rate of unemployment, then inflation is going to be super high. Let me draw this nicely. For you to comprehend what I'm talking about. Okay? This is my graph. All right? Here is unemployment. And here is inflation. Okay? Now, according to Professor Phillips, he said the two trades off. That is, if this is zero, if you want unemployment to be zero, then inflation will be high. Let's assume here is 10. And here is 10 as well. Again, if you want to have a zero inflation, expect to have high rate of unemployment. Okay? Therefore, the central bank here wants to achieve high employment. High employment, it means low unemployment. Now, low unemployment is costful. Why? Because inflation will rise. And inflation means what? Persistent increase in prices of goods and services. Persistent increase in prices. That's the reason now the central bank, by using monetary policy, also it has an objective to ensure that there is price stability. Because having high unemployment without price stability, you won't achieve stable economic growth. And even interest rate will be fluctuating. You will have another problem here. Okay? So for an economy to achieve stable economic growth, you need to have rate stability, price stability, and you need to control inflation. I think this one is clear. Why monetary policy has been entrusted with these functions? Why these functions have been entrusted to the monetary policy? It is because monetary policy wants to influence interest rate. Okay? monetary policy wants to influence interest rate. Okay, through what? Through money supply. That's the reason now these goals also needs to be achieved within the execution of monetary policy. We have financial markets. Remember, financial markets offers a platform for buying and selling of financial assets. So at the financial markets is where capital is raised. Okay, we raise capital from the financial markets. A stable financial market and a very high performing financial market can lead to a very good what? Economic growth. But if a financial market is not stable, or if a financial market crashes for any reason, for example, what happened in 2007, 2008, a crash in the financial market is what triggered what? Is what triggered the global financial crisis. But what caused these financial markets to crash? Banks. Even though there are some other factors, but banks were the contributing factors. Okay, besides banks, regulators were sleeping. Credit agencies were not doing their work. Now a collection of mistakes triggered the so-called the global financial crisis or the recession of 2008. So it is the function or the objective of the monetary policy to ensure that also there is a stability in the financial market. Last but not the least, stability in the foreign exchange market. Remember, we have what we call exchange rate. Okay, exchange rate simply means the price of one currency expressed in terms of another currency. What will happen if Tanzanian currency continues to lose its value as against other foreign currencies? For example, against dollar. If Tanzanian currency loses its value against dollar, the value of imports will be super expensive. Okay, the price of imports will be expensive if TZS depreciates as against the USD. And you know, every time we import, we purchase using what? Using the USD. Therefore, prices of any imported goods will be unbearable for most of the Tanzanians. Same goes to any country. Same goes to any country. Therefore, it is, and if you're having these high prices, might translate in themselves into what? Into inflation. Interest rate won't be stable. Therefore, it is within the interest of the central bank to ensure that foreign exchange market is stable, and so is the domestic currency of the given country. Now, I want to discuss you the way monetary policy is being executed in any given economy by the central bank. As I mentioned earlier, the central bank executes a monetary policy. Now let me draw in order to illustrate. Here we have monetary policy. Okay. Here we have monetary policy. Now, for the central bank to successfully execute monetary policy, it needs to use some tools. Okay, we call them tools for monetary policy. All right. The central bank needs to execute monetary policy using some tools. Okay. Now, monetary policy or the execution of monetary policy by the central bank, it can be, number one, to expand, we call it expansionary monetary policy, or to contract, call it contractionary monetary policy. Therefore, monetary policy is of two types. It can be expansionary monetary policy or contractionary monetary policy. I'm going to define shortly the meaning of this. Alright? Anyway, expansionary monetary policy, here the central bank wants to pump funds into the economy. Like if there are some liquidity crises or liquidity issues, businesses, individuals are complaining that we do not have fund. The central bank is responsible to ensure liquidity. Remember from the definition, central bank is responsible to ensure liquidity within the economy. That is to say now, central bank needs to release funds into the economy. Now, how the central bank can release funds into the economy is through execution of expansionary monetary policy. So this one is intended to release funds into the economy in order to secure liquidity. Okay. On the other hand, there might be some problems in the economy, like high rate of inflation due to too much money in the economy. So again, it is within the interest of the central bank to ensure that that one or that issue is controlled as soon as possible. Now, the central bank can start by executing the contractionary monetary policy. How? I'm going to show you later. I'm going to discuss with you later. But what I want you now to understand is contractionary monetary policy is there to withdraw funds from the economy. Okay? If the central bank wants to take away money from the economy, it uses contractionary monetary policy. If it wants to pump money into the economy, it uses expansionary monetary policy. But how this one can be achieved? This one is achieved through the uses of the tools of monetary policy. Now, what are the tools of monetary policy? Actually, there are 4 tools. However, I'm going to discuss with you 3 important tools. Okay. The first tool is known as open market operation. Okay, the first tool is open market operation. Okay, OMO stands for open market operations. Okay, here this one involves buying and selling of what? Buying and selling of government securities. What are the government securities? Treasury bills and treasury bonds. These are the government securities. Okay. Later I'm going to describe how the central bank uses this tool. The second tool is through reserve requirement. Okay, RR, reserve requirement. Here we're going to discuss something called SMR, statutory minimum reserve. Okay, so RR stands for reserve requirement. This one employs what? This one employs reserve rate. The third tool is known as discount rate, which is at the discounting window. Okay, discount rate. DR stands for discount rate. This is done at the discount window. So at the discount window is where banks goes to borrow money from the central bank. If someone asks you, central bank has a function of lender of last resort, where exactly does this happen within the central bank? It is at the discount window. There is where banks of all kinds will go to borrow some money from the central bank. So discount rate, here it employs the discount rate, or sometimes is called bank rate. I said therefore, however, I'll focus mostly on the three. The fourth one is moral succession. Okay, but for the purpose of the session, I'll focus mostly on the first three tools. Now, suppose that there is a liquidity crisis. Okay, suppose that there is a liquidity crisis in the economy. Okay, and the central bank wants to raise funds into the economy. How will the central bank execute this? Using the policies, the tools that I've mentioned. We have a liquidity crisis. If you guys remember, we used to call this vyuma vimekaza. Okay, now we have a serious liquidity crisis in the economy, and the central bank wants to release funds in the very same economy to rescue the situation. How can this be achieved? Using the open market operation. By using open market operation, remember I said it involves buying and selling of government securities. Therefore, here the central bank will announce buying government securities. Remember, government securities are what? Treasury bills and treasury bonds. By buying government securities, it means from investors, treasury bills and treasury bonds will be taken away, and the central bank will raise funds into the economy. Okay, therefore, if these are investors, okay, these investors have some treasury bills and treasury bonds. Okay, and here we have the central bank with a lot of money. So by buying government securities, it means this money will flow back into the economy, and these financial assets will come back to the central bank. So more money will be introduced into the economy. Let's assume 1 trillion is introduced into the economy. So if you introduce 1 trillion to the economy, it means treasury bills worth 1 trillion needs to go back into the central bank. That way, you assist liquidity in the economy or to that particular economy. Number 2. This was number 1.
Is that correct?
Yes, please.
I have a question.
All right.
So the central bank they are buying the treasury bills, right?
Yes,
Okay, from the investors.
from investors.
Okay, okay. Thank you very much.
You're welcome. Number 2, by using the reserve requirement. Maybe here, let me explain to you what is a reserve requirement. Reserve requirement, one moment please. Let me create some space to write here. What is a reserve requirement? Reserve requirement simply means the amount of money or funds that is required to be kept at the central bank at all time. It is required by law to be kept at the central bank. Very important. Please guys, remember this, okay? Someone asks you, what is a reserve requirement, all right? Reserve requirement, this is the amount of money that is required, okay? That is required by law to be kept at the central bank. Okay? This is the amount of money that is required by law to be kept at the central bank. You remember the other day, I showed you guys, I showed you the balance sheet of a certain bank in Tanzania. And on the asset side, I think the very first item was written reserve at the central bank. So there you can see the amount of funds that the central bank has kept, that the bank has kept at the central bank. That one is required by law. It's called reserve requirement. Now, I want to ask a question to you guys. What is the reserve requirement? What is the current reserve requirement in Ghana? And what is the current reserve requirement in Tanzania? Do you guys have an idea?
I think it's 10% in Ghana.
All right. I'm informed here in Ghana it is 10%. Guys, what about in Tanzania? Hello? Tanzanians, are you there? Okay. Currently is 8.5%. Okay, in Tanzania. 7 years ago it was 10, now it is 8.5%. And it was reduced to 8.5% back in 2016. I'll explain to you why. Before then, it was 10%, just like in Ghana. So, how does this work? Reserve requirement control the amount of money that will be available to a bank to be used for issuing credits or investment activities. Okay, I say again, reserve rate. Okay, the reserve rate control the amount of money or funds that will be available, will be at the disposal of the bank to be used for different investment activities or issuance of what? Of loans. Now, if the central bank wants to pump some more money into the economy, practically it will lower or it will reduce, okay? The central bank will reduce the reserve requirement or the reserve rate, okay? Reduce reserve rate. Reserve rate sometimes called statutory minimum reserve. So this one will be lowered. Okay, let me give you a practical example. Suppose that currently reserve requirement in Ghana is 10%. Okay, the SMR in Ghana is 10%. What does this mean? It means if I do have 1 million, if a bank receives 1 million Ghanaian cedis for deposit, okay, if a customer goes to a bank and deposit 1 million Ghana cedis into a bank, what will happen to this money? It is not true that the bank will be allowed to use the entire 1 million for investment and issuance of loan. No. What will happen here is that the bank will have to take out 10%. So you have to compute 10% of this amount, of this deposit. Now, if you are to multiply 10%, you'll get the amount that will be kept at the central bank and the amount that will be available for investment by this particular bank in Ghana. Now, if I'm to do math here, okay, what will be the 10% of 1 million? 100,000, right? That would be 100,000. So that is to say, this Ghanaian bank, okay, this Ghanaian bank needs to, please mute your microphone. This Ghanaian bank needs to deduct 100,000 from 1 million, okay? That means at its disposal, it will remain with what? 900,000. Therefore, the 900,000 is what will be available to this bank for loans and investments. And the 100 goes to the central bank. Okay, the 100, this one goes to the central bank. So in the books of account of this Ghanaian bank, they have an asset of 100,000. And this one is the liability to the central bank. So this is the amount that, the 900 is the amount that this Ghanaian bank will use for investments. Okay, let's assume there was only one deposit throughout the entire year. Okay, now since there is a liquidity crisis in the economy, central bank decides to lower the statutory minimum reserve from 10% to 8%. Actually, this is what happened in Tanzania back in 2016, April 2016. Okay, so it's a very good example. The Central Bank of Tanzania lowered the statutory minimum reserve from 10% to 8.5. Now, if it's 8.5, what will happen? Let's do the math again. If a certain customer comes to a bank and deposits Ghanaian cedis 1 million, okay, then this Ghanaian bank will have to multiply by 8.5 in order to see how much money will be available at the bank's disposal. In this setting here, you see that 85,000 will go to the central bank, and the rest is what? And 915, this one will be used by a bank for loans and other investment activities. So you see, following lowering of the reserve, statutory minimum reserve or reserve rate, the amount of money available in the economy for investment has increased. Okay. Now, how about the discount rate? Now, by using the discount rate, okay, using the discount rate, again here, the central bank will have to reduce the discount rate in order to increase the money that will be available in the economy. How? To understand this, first, let's define or let's get the meaning of the discount rate. Okay, what is discount rate? Let's start from there. Or anyone, is there anyone who can tell me what is the meaning of the bank rate? And bankers, can you tell me what is the bank rate, current bank rate in Tanzania? Abdullah, do you have an idea what the current bank rate in Ghana? Maybe let me define first, and you guys will get an idea of what I'm talking about. All right. What is a bank rate? A bank rate simply means the interest, the amount of interest, okay? The amount of interest that central bank charge to banks that borrows money from it. Okay? Therefore, if your bank wants to offer some more loans to the economy and it decides to go to the central bank to borrow some more money, okay, in order to have a lot of funds available for loans, then at the central bank that money will be offered at a certain fee or at a certain cost, and that cost is called bank rate. So bank rate is the cost or the fees of borrowing money at the central bank. This is the interest that central bank charges commercial banks whenever they approach the central bank to borrow money. I told you guys that at the central bank there is what we call discount window. Okay, there is what we call discount window. Now there are three discount windows. Okay, there are three discount windows. Number one is called the primary discount window. Number two, secondary discount window. And number three, seasonal discount window. Seasonal discount window is where banks will go to borrow some money that will be used to offer loans in some seasons. For example, in Europe, there are some seasons where farmers are harvesting, so they need some funds. Bank can go to these seasons and borrow some money for that activity. Primary window, this is where health banks, okay, goes to borrow money. If a bank has any financial problem, bank has no liquidity crisis, it simply wants some money to be used for investment activities, we call it a healthy bank. Therefore, healthy bank goes to the primary window. But if a bank is in crisis, like Lehman Brothers or Trigger Bank, then they go to the secondary bank. So here is where the function of lender of last resort is being performed. Okay? Now, as I said, if health banks go to primary window, money borrowed is at a fee. A fee is called bank rate. Now, I think currently bank rate is 6%. Okay? That means a certain commercial bank, call it bank XYZ, goes to the central bank, borrow money at 6% and comes to customers and offer loans. Okay? So it offer loans at a certain interest that will be higher than 6%. Let's assume that there's no any other cost and the banks decide to just add a profit from this one. That is to say, a bank can go and borrow money at 6% and come to loan out at 8%. Therefore, the bank will earn 2% profit. But
Mr. Fred,
yes, please.
I'm having a question concerning on the lending on this side. Only banks are the ones that are allowed to borrow fund from BOT. Or a firm, like let's say Baresa, is it allowed to
No.
take a loan at BOT?
Baresa needs to go
Or
to the
only
bank.
banks?
Baresa, companies, multinational companies, whatever, they need to go to commercial banks. So only commercial
Okay,
banks.
thank you, sir.
Yes, you're welcome. All right. Therefore, a bank can borrow money at the central bank at 6%, give out loan at 8%, earning a profit of 2%. Please understand, this is hypothetical example. The interest rate that is charged by banks is not calculated this way. I've just simplified this one only for the purpose of learning. Okay, so this is a purely hypothetical example. Now, probably customers are concerned that 8% is still very high for them to borrow. And due to this complaint, central bank decides to lower the interest rate, the bank rate. Now, if the bank rate is lowered to, let's say, 4%, it means the banks, commercial banks, will have big window or big room to borrow some more money. Why? Because now it has become cheaper. It has become cheaper to borrow money from the central bank. Initially, it was 6%. Now it is 4%, which means banks have even bigger room to borrow some more funds from the central bank. And at 4%, the bank may come and give out loans at, let's say, 6%. Therefore, at 6%, more customers will come to borrow some money from the bank than at 8%. So in several times, whenever you listen, if you pay attention to politicians when they are talking about creating liquidity, enhancing economy, they'll talk about banking loans, interest rate, etc. So this is what actually they are trying to tell you. But in order for a bank to arrive to the appropriate interest rate to charge for any given loan, the bank not only needs to consider bank rate, there are also some other factors, okay? So the interest rate that a bank may charge, okay, needs to consider the following. Needs to consider first the bank rate. Okay. Again, it needs to consider inflation target. Okay. That is the reason every single year the Minister of Finance needs to inform the public inflation target, and the minister will get this information from the central bank. So, for example, if inflation target in Tanzania is 3%, then this one needs to be considered. Again, there is cost of capital, the profit that the bank wants to raise. So let's say profit margin, plus any other cost, such as insurance. All this needs to be considered for a bank to arrive to an appropriate interest rate to charge for a certain loan. That is the reason in a bank, when it comes to issuing loan, particularly issuing loans to corporate customers, bank does not just come out with a rate and say, okay, this is what we're going to charge you. No, they sit down and discuss. They start negotiating. And during the negotiation, the treasurers of the bank might propose like 3, 4, or up to 5 interest rates to charge. So the preposition actually comes after considering these factors, the factors that I have mentioned here. There can be some more factors that I don't know, but at least these factors need to be considered. Bank rate, inflation target, profit margin, insurance, because now loans, we need to put insurance into consideration, etc. Okay. Now guys, you have seen this is how a bank, central bank, execute expansionary monetary policy. By using open market operation, it buys government securities. Reserve requirement reduces the reserve rate, and in case of a discounting rate, reduces the discounting rate. That way, more money will flow into the economy. More money into the economy, okay? Now, if you reverse this, okay, the opposite of this, the opposite of 1, 2, and 3 will be all about pursuing contractionary monetary policy. I'll say again, if you reverse what we have discussed under 1, 2, and 3, okay, then you will be pursuing contractionary monetary policy. That is to say, if you want to take money away from the economy, all you have to do is to sell government securities. Number 2, all you have to do is to increase the statutory minimum reserve. And 3, increase the bank rate or the discount rate. That way, you take away money from the economy. So here, more money into the economy. Here, you'll end up with less money into the economy. Now, it comes to a question. If you are really in serious problem or trouble, can you rely on monetary policy to deal with the problem? The answer is no. Why? Monetary policy is too slow. Okay? It takes a lot of time for the effect of monetary policy to be felt. I usually compare monetary policy to a doctor who have just prescribed some tabs or capsules to treat a certain infection to a patient. But if a patient, okay, we have a very good example here. Look, if you are suffering from moderate malaria, doctor will prescribe to you some tabs. Okay, the doctor will prescribe to you some tabs. But if you have a cerebral malaria, very serious malaria, no any single doctor will prescribe to you the tabs. They need to give you something which will take effect faster than the tabs. That will be an IV. Okay, so an IV is the appropriate solution. Likewise, if the economy is in serious trouble and you really need the effect to take place right away, monetary policy is not the appropriate policy to use. You need to look for another policy, which we'll discuss shortly. And why monetary policy might not assist you in this time. Also, the tools that we have discussed, okay? Some of the tools are at the discretion of the banks to use. For example, buying of government securities or buying and selling of government securities. There is no any law that forces an individual or a bank to immediately go to buy or sell these government securities. So a certain investor may decide to withhold these securities. Even a bank might decide to allocate just a little amount of funds for buying securities. So most likely the target won't be achieved. Again, using the discount rate, okay? Using the discount rate, there is no any single law that pushes banks to go to the central bank to borrow money. Actually, some of the banks, like these bigger banks, they do have sufficient profit. Now, if a bank has made a very big good profit over the years, most likely it will have a sizable retained earning. Okay, therefore the bank can use this retained earning for loans instead of coming to a central bank to borrow some money. So you can see that tool number one, okay, tool number three are at the discretion of banks or individuals. Even these tools here, number four, moral succession, again, it is at the discretion of individuals. I'm gonna leave you guys an assignment. You need to go and read about this. Okay, but here it's only reserve requirement that compels banks to obey. Why? Because we define that reserve requirement simply means the amount of fund that is required by law to be kept at the central bank. Therefore, if SMR changes today, the bank will issue an ultimatum, a deadline for all banks to comply. That's the reason, I don't know in Ghana, but in Tanzania, you must have seen those orange motor vehicles, okay? They came to your branch to collect some money, okay? They came to your branch all the time to collect some money. So the vehicle can come to your branch, collect some money to your bank HQ, and if again a certain level is reached, then the required amount, the RR, needs to be taken to what? To the central bank, okay? To the central bank. Remember, every business day, you guys mobilize what? You mobilize deposit in every business day. Therefore, in every single deposit, if a customer comes today and deposited 1,000, remember you need to take out 100. This one needs to go to the central bank. Another customer comes, deposits 10,000. Remember, you need to take out what? 1,000 to the central bank. Another customer comes, deposit 100,000. Remember, you need to take out 10,000. All right? And so on and so on and so on. So therefore, this amount that we've collected needs to go to what? To the central bank. But before I move further, I want to tell you, please do not confuse what we call excess reserve. Okay? There's what we call excess reserve, and we have the reserve requirement. Okay? Reserve requirement, this is the amount that is required by law to be kept at the central bank. Excess reserve, this is extra fund. Okay? This is extra funds that the bank has decided at its own free will. Okay? At its own free will to keep at the central bank. So what I want to say is, it is not all the time when you see those orange vehicles come to your bank, they are coming to collect the reserve requirement. Sometimes they may be collecting excess reserve. But in a balance sheet of a bank, you will simply see a single item and asset, which is reserve at the central bank. But just know that over there are two types. Okay, so I'm sure in the books of a bank, okay, or if you go to the treasurer, they'll tell you the exact amount which is the reserve requirement and which one is excess reserve. Excess reserve can be withdrawn at any time by the bank. Okay, excess reserve. Reserve requirement usually is not withdrawn, but excess reserve can be withdrawn by commercial bank at any time. So again, you can see why monetary policy might not take effect as it should be, as it's expected, because a bank that has a sizable retained earning, which is excess reserve, let's assume, can simply go to the central bank and withdraw money from here, okay, and avoid going to the discounting window where it will be charged a certain percentage because of the presence of bank rate. All right, now that we are done with monetary policy, I want to turn my attention to another policy. Oh, I think there's a mistake here. I should have fiscal policy somewhere. All right, I think that I should have fiscal policy. Apparently I cannot see it, but it's not a problem. Let's have a nice discussion over here. Okay, now I told you guys it is very possible to use a combination of two policies in order to achieve the desired goal. Okay, we have already discussed the monetary policy, so please cast this aside. Now I want to discuss with you fiscal policy. Okay, fiscal policy. And remember, I told you it is very possible to use both monetary policy and fiscal policy at a go. Now, fiscal policy, this is a central bank policy that is as well used by the bank to pump money into economy, particularly if a bank also wants to deal with liquidity crisis or inflation. Monetary policy influences, okay? Monetary policies influence interest rate through what? Through money supply. That's monetary policy. Fiscal policy does not, or it has nothing to do with interest rate. It does not want to influence interest rate, same way monetary policy is supposed to do. No, it's a bit different, okay? This is because even the tools used by fiscal policy are completely different. But if you ask me, fiscal policy takes effect immediately than the monetary policy. Now, fiscal policy can be, just like monetary policy, expansionary, or it can be contractionary. Okay, so we can have expansionary fiscal policy or contractionary fiscal policy. However, to pursue fiscal policy, to pursue either expansionary or contractionary fiscal policy, the central bank needs to use fiscal tools. Okay. Now, the fiscal tools are government expenditure, and tax. That is to say, now, if we want to pursue fiscal policy, the central bank will simply serve as an agent of execution. Why? Because taxation and government expenditure are not entirely reliable on the central bank. The government needs to authorize this. Some of the projects needs to go through the parliament before they could be executed. Now, if we want to pursue expansionary fiscal policy, like we want to pump some more money into the economy, what we do is we use government expenditure. How? Increase government expenditure. Okay, increase government expenditure. By increasing government expenditure, it means some more money will be pumped into the economy. How? If the government offers some more jobs, okay, if more people are employed, they're going to get paid salaries and wages, allowances, etc. So that is money flowing into the economy. If the government embark into massive projects, okay, if the government embarks into massive projects, what will happen? If the government is into a certain massive project, it means more people, more individuals will be employed into these projects. So more individuals will be employed. That means that's money. To do a certain project, for example, in Dar es Salaam, there is a construction of roads for these rapid buses to beat the traffic. We have another project, SGR, the fastest trains. Okay, so you can see there are a lot of people who have been employed in those projects. That is to say, in absence of those projects, those people will be home, jobless. I'm sure you guys have seen a lot of laborers, okay, a lot of laborers, because in these projects, there are some professionals with the required expertise who will be employed, but also even some guys with little or no skills at all also will be employed. Some might be used to do the cleaning, security issues, drivers, etc. So that is more money flowing into the economy. It's a win-win situation. People will get some money. To the extent that the moment a certain project is completed, everyone will say, yes, I've benefited somehow from this project. Like for instance, when the project moves somewhere, more individuals will migrate to that area and offer different services to those who are taking that project. Some will sell foods, some will sell water, some will offer security, etc., etc. So by doing so, the government will be pumping money into the economy, increase government expenditure. But another tool is tax. Tax has an adverse impact on consumption of individual or on expenditure of individual. If an item is sold at, let's say, 1,000 Ghana cedis or Tanzanian shillings and is taxable at, let's say, 18%, okay, the price will go up. But if you lower tax, for example, if you charge 15%, price of the same commodity will decline. Therefore, what you can do here is, and by using tax, you decrease tax. Okay, if you decrease the tax, then cost of goods and services will as well decrease. So goods and services will be affordable to individuals. Now, if you apply both tools at a go, that means more money into the economy, and most likely everyone will be happy. Now, if you reverse this, okay, if you reverse these two, then you'll be pursuing contractionary monetary policy. That is, you decrease government expenditure, okay, decrease government expenditure and increase tax. Okay, if you decrease government expenditure and increase tax, then more money won't be available into the economy. So guys, you might remember some few years ago, okay, there was a certain regime, no jobs were offered. Okay, again, many public servants were sacked. No new jobs, okay, sorry, no new jobs, public servants sacked, few government projects, okay, and those few that were offered also were being done by government institutions, okay. So very few government projects were offered, but also they were taken by what? They were undertaken by government institutions. And also there was effective collection of tax. Tax was never increased, just effective collection of tax, okay, like the introduction of EFD machines, etc. This is what led to what? This is what led to vyuma kukaza. Guys, to that particular point, is there any question? Anyway, hold your questions. Let me finish. I have some few minutes left. There are some policies which we never discussed. Okay, we've already discussed this one and this one. Exchange rate policy. Okay, here central bank is supposed to ensure that the exchange rate of a domestic currency is stable. That is to say, the domestic currency no need to be, it shouldn't be high value or low value. Why? If your domestic currency is too expensive, then the value of your export will be too expensive to your customers. So that is a problem. Again, if it is too low, it means the value of import in your country will be expensive. So you need to ensure that the exchange rate is somewhat stable at an acceptable rate. That is the reason one day Ms. Chiku shared with me a certain letter document from the Central Bank of Malawi, if I'm not mistaken. The Central Bank of Malawi is trying to determine the exchange rate of Malawian kwacha against USD. The policy being used there, Chiku, is this one, exchange rate policy. Prices and income policy. Remember, objective or goals of monetary policy. There is an issue of high employment and what? Stable prices. Okay? So income policy defines salaries and wages. We cannot have, for example, if a country has a population of, let's say, 100,000 individuals, and in this population, let's assume 50%, okay, are public servant earning salary. You cannot have 75% of these individuals, public servant, earning a lot of money. You may cause a problem. So don't be surprised when you hear that there are some working class in your country complaining that ever since we have low salary, why our salaries never increase, why we don't have too much allowances just as workers in some other sectors. There is a reason for that, and the reason is right here. I don't want to talk much about this. If you have too much money in the economy, you may end up with inflation. So prices. By using this policy, the central bank want to ensure that income and prices within the economy is controlled. National debt management policy. You guys must know that sometimes our government goes to borrow some money, okay? Government borrows some money, okay? Now the government can borrow internally or externally, okay? In most cases, if the government wants to borrow internally, it might sell treasury bills or treasury bonds. That is to say now, whenever you see central bank advertising an auction, you need to have two things in mind. Number one, it might be that a central bank or the government wants to pursue a certain policy. Can be contractionary or expansionary policy. Or maybe the government wants to borrow from the public. This is what we call public debt. Okay. Therefore, it is the function of the central bank to ensure that the national debt is under control. Okay. You don't want to enter into a situation whereby creditors will refuse to give you loan simply because you are not credit worthy. And I'm sure, guys, you must have had this discussion in the parliament in several occasions. That is the reason. This marks the end of this evening's discussion. However, I would love to show you some announcement from the central bank regarding to the sale of treasury bills and treasury bonds, and also a balance sheet for those who were not around to see what I was how it is recorded in the balance sheet of a bank, what I've just explained to you, like with respect to the excess reserve and the reserve requirement. But in the meantime, I invite you guys to ask questions if you have any. Otherwise, thank you very much for listening.
Thank you, sir.